If you're a retiree in Michigan, you know the pension tax has been a decade-long headache. Well, that promised repeal from 2023, the 4-year wait is finally over. But hold on, because a brand new law just changed the game all over again. So let's dive in and break down what this actually means for your wallet in 2026.
Okay, so here's what we're going to cover. First up, we'll talk about what this full repeal of the pension tax really means for you. Then, we'll get into the brand new deduction limits for 2026. Third, and this is a big one, we'll cover a new temporary double-dip window that could save you a ton of money. And finally, we've got a really important fix for state corrections officers.
I know. For years, retirees across Michigan have been waiting for this moment. That whole complicated, messy, multi-year phase-in of the pension tax repeal, it's finally done. So, as we look at the 2026 tax year, we're dealing with a whole new landscape.
But to really get where we are now, we have to look back at how we got here. See, this wasn't like flipping a switch. The state phased this in over 4 long years. It started with just a 25% deduction back in 2023, then it bumped up to 50% in 2024, and in 2025, it was 75%. And now, finally, for the 2026 tax year, we've hit the 100% mark. The phase-in is officially over.
So here's the bottom line, and this is so important. That old, confusing system that split everyone into different tiers just based on when you were born, it's gone, wiped away. It doesn't matter anymore if you were born in 1945 or 1965. Starting January 1st, 2026, there's one set of rules for everyone, and every single retiree is now eligible for that full maximum deduction.
All right, so the phase-in is done. The big question is, what are the new deduction limits? What can you actually claim? Let's get into the real numbers, the ones that are adjusted for inflation that you'll be using for the 2026 tax year.
Okay, here it is. This is the new magic number for most retirees. If you're filing jointly and have private retirement income, from a 401k or an IRA, your projected maximum deduction for 2026 is going to be right around $135,000. And this isn't just a guess. This number comes straight from the official inflation data.
So how do we get to that number? Let's break it down. We start with the numbers we already know from 2025. Then, the State Tax Commission gives us the official inflation multiplier for 2026, which is 1.027. You do the math, and that brings us to a projected cap of about $67,676 for single filers, and that $135,352 figure for those filing jointly. These are the new ceilings for your private pension and IRA withdrawals. Okay. Now listen up, because this is a rule that trips up so many people. It's called the offset rule. You cannot, I repeat, you cannot just stack your public pension deduction on top of the full private pension deduction. It doesn't work like that. Think of it like this. Let's say you're a retired teacher with a $50,000 public pension. Great, that $50,000 is tax-free, but you then have to subtract that $50,000 from your private deduction cap. You can't have both. All right, I need you to really lean in for this next part because this is probably the most critical, time-sensitive piece of information we're going to cover. A brand new law, Public Act 24 of 2025, has just opened up this temporary but really powerful opportunity. But it's specifically for retirees who were born after 1952.
You see, for years, there's been this thing called the standard deduction trap. If you were born after 1952, you could technically take a standard deduction. But here's the catch. The state forced you to reduce it, dollar for dollar, by whatever you got from Social Security. And for a lot of people, this meant their standard deduction just vanished. But this new law, it changes everything, at least for a little while. Starting in 2026, it gets rid of that offset. So now you can deduct your full Social Security and take the full standard deduction. You get both.
Now, it is absolutely critical to understand this is not a permanent change. This is a 3-year window. It only applies to the 2026, 2027, and 2028 tax years. So during this small window, you get to double dip on these deductions. It's a huge deal, but it is temporary.
So, what does this all mean? Well, it means if you were born after 1952, you now have a big choice to make. Come 2026, what's the better move? Do you take the big pension deduction or do you take this new supercharged standard deduction? And there's no single right answer. It all comes down to your personal financial situation.
Okay, let's try to make this simple. Here's a little decision tree for you. First, look at your retirement income. Do you have big pension or IRA withdrawals? We're talking more than that $40,000 standard deduction for joint filers. If so, then the much larger pension deduction is almost certainly your best choice. But what if your pension is smaller and you have a lot of other income, say from interest or dividends? In that case, the standard deduction might be the smarter play because it's more flexible. You can use it against any type of income.
Okay, let's shift gears for our last big update. This one is really specific, but it's incredibly important. For years, there was a group of public safety officers who were just left out of the tax relief because of a mistake in the law. Well, I'm happy to say that has finally been fixed.
This whole problem was known as the corrections gap. You see, back in 2023, when the first tax relief for public safety officers was passed, it included police, firefighters, and, importantly, county corrections officers. But for some reason, state corrections officers, the ones with the MDOC, were accidentally left off the list. This created this totally unfair situation where a county deputy's pension was tax-free, but a state prison guard's wasn't. It made no sense.
Well, that inequity is now officially over. House Bill 4201 made its way through the legislature and was signed into law. This new law fixes that mistake. It adds state corrections officers to the list of public safety retirees whose pensions are now 100% deductible from Michigan income tax.
And, a quote from the bill's sponsor, Representative Kathy Smaltz, really sums up why this was so important. She said, "They dedicate their careers to protecting the public, yet when they retire, they're hit with an unfair tax that other first responders don't have to pay. That's wrong, and I won't stop pushing until this injustice is corrected." It really was about fairness.
And here's the best part. This fix could mean money in your pocket right now because it's retroactive all the way back to January 1st, 2023. So what does that mean? It means if you're an MDOC retiree and you paid state taxes on your pension for the 2023 and 2024 tax years, you are almost certainly owed a refund. You'll just need to file amended tax returns for those years to get that money back.
So, as we wrap all of this up, you've got the full repeal, this new double-dip window, the fix for corrections officers. It all boils down to one final, really important question for you. With all these new rules coming into play, have you actually audited your own retirement plan for 2026? Because taking a fresh look now, well, it could literally save you thousands of dollars.